On the ET Money YouTube channel, we have a number of videos on index funds. We have explainer and conceptual videos, there are comparison videos, details on important indices, and also good coverage on the not so popular ones. The fact remains that millions of investors across the world and also in India have their eyes trained on these passive investing instruments. So in this video, we shall examine 9 different types of index funds that one can invest in. Understandably, each of the indices have a different construct, serve a different purpose, resonate with different risk profiles, but importantly, each index has a defined role to play in an investment portfolio, which is something we'll discuss in greater details in this video. Let's begin. On the face of it, a broad market index is nothing but an impersonator. After all, what it tries to do is to replicate a large expanse of the investable stock market. In other words, think of an index as a small-scale architectural model of a full-sized building. Now, there are over 5,000 companies that are listed in the Indian stock exchanges, but as is often the case, just about 10% of these companies make up over 95% of the stock market's total capitalization. From an Indian context, the Nifty 500 index fund, like the one offered by Motilal Oswal, would be a good fitment for the term broad market. Additionally, Navi Mutual Fund has recently filed for a total market index that will give investors exposure to 750 stocks across large, mid, small, and even micro-cap companies. While this word total market that the team at Navi Mutual Fund has coined is a bit new to the Indian investors, it is a very common term that's used in the United States. In fact, broad market funds like the Wilshire 5000 Total Market Index Fund, the Russell 3000 Exchange Traded Fund, and the Vanguard Total Stock Market Index Fund receive a lot of investor money in the United States. So in essence, the broad market index looks to capture the total performance of a stock market and is truly designed for long-term investors. Perhaps the only point one needs to be aware of is that if you invest in a broad market index and also invest in other index funds, then there is bound to be some overlap in the holdings. This really can't be avoided, but one should not be particularly bothered with it as long as you are diligently tracking your overall asset allocation across large, mid, and small cap companies, irrespective of whether you are investing via mutual funds or via stocks. Size does matter. It's an aphorism that is deeply entrenched in our society, and more so when it comes to finance and investing. A majority of the available index funds are weighted by their market capitalization. The Nifty 50, the Sensex, the Nifty Next 50, the Mid Cap 150, Small Cap 250, the Nifty 200 are all examples of indices which are market cap weighted. So by construct, if a company has a very high market capitalization, then it's labeled as a large cap company and makes its way into an index like the Nifty 50 or the Nifty Next 50. Moderately sized companies, generally in the 13,000 to 30,000 crore range, are tagged as mid caps, and the small and micro cap companies make the lower end of the funnel. Now, specifics on what comprises a large, mid, or small cap, their performance information, their cross analysis with other metrics are all available in a previously released video on the ET Money channel, so we won't go there. But what we'll do here is to spend a minute on understanding what is probably the most fundamental flaw in market cap weighted index funds. Now, we all understand that stocks often follow a meandering path, and in that context, it is best to assume that almost every stock is overvalued or undervalued at any given point in time, which is another way of saying that a market cap index gives a higher weightage to an overvalued stock and a lower weightage to an undervalued one. So when we hold on to this thought, every additional rupee that gets invested in an index fund does nothing but add more fuel to this existing distortion. This ends up disproportionately increasing the price of some stocks at the expense of others, which in one way can be interpreted that index funds are partly responsible in extending bull runs by making stocks more and more expensive. Of course, when these expensive stocks become unsustainably expensive, mean reversion starts to happen, which then leads to a quick and deep market-wide correction. Well, that's at least my theory, but again, if you are a long-term investor, you should be open to short-term volatility and shouldn't really be bothered with this one bit. Now, one way to counteract the over and underweightedness of a market cap weighted index is to go for an equal weight index. Simply put, an equal weight index is one where every stock in the index carries the same weight. For instance, if the index under consideration is the Nifty 50, then all 50 companies are conceptually weighted at an equal 2%. In other words, think of an equal weight index like a perfectly balanced ship that is looking to avoid the storms that are often created by price momentum or valuation biases. Now, traditionally, an equal weight index is more value oriented and is definitely a lot more diversified as compared to its market weighted cousin. Case in point is the Nifty 50, with the equal weight index showing a lot more sectoral diversity as compared to the market cap version. But let's be a little realistic here. After all, sector diversity is not what we are really interested in. Investors seek performance, so let's look at how the Nifty 50 and the Nifty 100 have done under the market cap and equal weighted approaches. Now, on a 5-year basis, the market cap has been the clear winner with a 2.5% alpha over the equal weighted indices. But when we do this comparison over a much longer period of time, say from when the indices were actually started, we see that the equal weight index has actually outperformed the market cap one by at least 100 basis points in yearly returns. In fact, this is something we have read in many places, that the equal weight index tends to deliver better returns as compared to a market weighted index, especially when the time horizon is really long. The market capitalization approach is the most popular way of creating an index, but it need not be the only way. Other attributes like the P/E ratio, the dividend yield, book value, cash flow, sales, etc. can serve as worthy replacements and can probably do a better job of identifying attractively valued companies to an index portfolio. Today's computers are a lot more powerful and are quite capable of churning and learning from complex data streams and financial metrics. It's these insights that are then categorized into neatly packaged characteristics called factors, which then go by the labels of value, momentum, quality, volatility, etc. There is no denying that factor-based index funds are getting popular by the day. You might have even heard some not as factor funds, but more as smart beta funds, which is definitely a more marketable name. Now, most smart beta funds that are being launched here in India comprise of a single factor. For example, the Edelweiss Nifty 100 Quality 30 Index uses the quality factor, which is a concoction of multiple metrics like the ROE, the return on capital, the company's operating cash flows, the debt in the company, etc. Similarly, there are index and exchange traded funds that use the volatility factor, some others apply the value factor, while a few more ascribe to the momentum factor. But lately, we are seeing the emergence of multi-factor funds, that is, index funds that use 2 factors and sometimes even 3 factors. These multi-factor index funds aim to offer a more comprehensive investing option by managing returns, risk, and volatility in a more efficient manner. It's a very interesting area of study, and if you would like to know more on this, then do watch our video on smart beta funds, where we have discussed multiple factors, the performance of these funds, their merits, concerns, and more importantly, should one be investing in smart beta funds. So do watch out for that. It's an area that we think is going to be even more important as it expands and improves over the coming years. Hedge funds actively employ various strategies to generate excess returns for their investors. These outfits often use leverage, derivatives, and short positions, which is not something that everyday investors like you and me do, but that doesn't mean that we don't have those options. Take the Nifty 50 TR2X leverage index, for instance. The strategy this index employs is to magnify the exposure to the Nifty 50 index by a multiple of 2. which means if the Nifty 50 goes up or down by 5%, then the value of this index will correspondingly go up or down by 2 times of 5%, that is 10%. Take a look at this comparison table where we have examined the returns and volatility metrics of the 2x leverage index with the regular Nifty 50 index. We can clearly see a directional doubling of the returns and risk when using the 2x leverage strategy. Now, finding funds that use strategies like this are quite difficult presently. As a matter of fact, we could not locate a single fund or ETF in India that uses the 2x leverage approach, but we did find one instrument in Korea that made use of this very strategy to generate returns for their investors. So leverage is just one strategy, but there are a lot more strategies that can be used to construct an index fund. Strategies such as arbitrage, futures, dividends, inverse index, beta, and even currency can be used to create indices. And while these are not mainstream, I won't be surprised if some of these start finding a place in the index shelf maybe 3, 4, 5 years from now. Investing in sector-based funds or ETFs is something that many people do. They invest to gain a broader exposure to a sector, which hopefully is done to diversify one's portfolio rather than trying to time the market. Today, there are sector-specific index funds and ETFs in banking, technology, healthcare, infrastructure, consumption, etc. The funds generally cater to broader categories, but it's not uncommon to see some index funds having a much narrower and specific mandate. For instance, a banking sector index fund is based on the broader banking category, but then investors can also choose a PSU bank only or a private bank only index fund. The Indian investment industry has seen quite a number of launches in this space over the last few months, and we believe it's a category that is primed to grow at an accelerated pace. Earlier in the year, we did a video on international funds, and as I recall, there were barely 3 or 4 passive investing options then. But the last 8 months has seen a spate of offerings in the international index fund space. Now we have funds tracking multiple US-specific indices such as the NYSE FANG Plus Index, the S&P 500 and the Nasdaq. Then there are a couple of funds that track the Hang Seng Index. And now we also have access to some developed market indices that operate in isolation or as a combination of funds. While the past performance of some indices, particularly the US-based ones, have helped in building warmth with Indian investors, a pleasant consequence of this has been the improving diversification of one's portfolio. Take the NYSE FANG Plus Index as an example here. Now this index constitutes 10 highly traded internet and technology stocks in an equal weighting format, the likes of Alibaba, Tesla, Facebook, Twitter, Apple and others. The metric of interest for us here is the performance correlation of the NYSE FANG Plus Index with the Nifty 50. You see, this correlation is a mere 0.15, which makes these two indices polar opposites in terms of performance and the kind of companies and sectors that they represent. This not only enables essential diversification, but it also helps address some of the gaps that one might have in one's portfolio. Debt-based index funds is not a common topic of discussion amongst investors. But what these funds lack in awareness, they more than make up for that in terms of their utility. In this section, we shall be talking about target maturity index funds which solve for 2 nagging problems that most investors have with debt, which is firstly, the price of the bond keeps going up and down due to interest rate changes, and secondly, the credit risk, that is the probability of some bonds defaulting within the portfolio. And this is where target maturity index funds come in, which are custom built indices that invest in line with a particular mandate. Take for example the recently launched ICICI Prudential PSU Bond Plus STL 4060 Index Fund. This is a passively managed scheme which replicates a custom index that comprises of 8 AAA rated PSU bonds and 20 state development loans in a 40-60 ratio. Now, while the scheme is open-ended, this debt index fund does come with a maturity date, which in this case is the 30th of September 2027. So if an investor were to invest until maturity, then A, the interest rate risk is taken care of, and B, since the investments are going into PSU bonds and AAA instruments, the credit risk is also mostly taken care of. Debt index instruments are getting popular now with many fund houses launching schemes in this category. For instance, Aditya Birla Sun Life and Edelweiss have something similar to what ICICI Prudential has. Edelweiss also manages the Bharat Bond Index, which is a low-cost, passively managed instrument that invests in AAA rated public sector bonds. Axis has a bond fund, Nippon India has multiple funds, and IDFC too has a few gilt index funds that invest only in government securities. Most of these are recent launches, and if you want to know more about target maturity funds, then do watch our video that we have hosted on the ET Money YouTube channel. And for more information on these schemes, do access the ET Money app, which gives you a range of useful metrics like the fund's returns, its portfolio, AUM, past performance, their rating, their ranking, and a wonderful fund report card which will assist your decision to invest or to not invest in a fund. A standard index operates on a one-size-fits-all model. But as more data processing power gets unleashed, it helps create a pathway for a lot more personalization on basis of what the fund manager wants and what different investor groups seek. This is where custom indices come in, which allows institutions and advisory firms to create their own set of investing strategies under a passive framework. Think of it like the architect giving you a basic set of blueprints but allowing you to tweak the construction per your specific requirements. Now, custom indexing, although not mainstream, has started to find its feet with many global financial institutions adopting it in the backdrop of progressive technologies and, of course, zero or low commission trading fees. Our interaction with fund houses in India shows that there is much warmth towards building custom indices, and these should be more popular in the next 3, 4 or 5 years from now. And with this, we come to the end of this video. Index funds have surely come a long way since 1976, when the Vanguard Group launched the first publicly traded index fund. A lot of the schemes we have discussed and selectively put forth in this video are available on the ET Money app for you to research and invest in. And since the ET Money app only offers zero commission direct plans, this is certainly one great incentive for you to use our platform. With that being said, thank you for your time. Do subscribe to our channel, tap the like button, share the video with your friends, and I look forward to catching up with you next week. Until then.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.